Imagine an asset that has not broken its all-time high of $3.84. 8 long years.
It's a long time in crypto.
Right. 8 years. We're looking at the charts right now, and this digital asset is currently trading somewhere in the neighborhood of $1.35 to, well, maybe $2.27.
Yeah, bouncing around that range.
Exactly. And if you look at that purely on the surface, you might think, it's a dead end, a relic of a past bull market.
Sure.
But then you see the actual data hitting the desk, and you get this massive cognitive dissonance.
Oh, massive.
Because despite this incredibly lagging retail price action, institutional analysts, and we are talking the absolute heavyweights of Wall Street here, are currently modeling scenarios where this exact same asset could hit $8, $60, or even a mathematically driven $315.
It is a staggering contrast. You have the situation where retail investors are staring at their screens, maybe feeling a bit of panic or just fatigue.
Yeah, definitely fatigue.
While entirely independent of that, institutions are quietly and methodically building massive infrastructure behind the scenes.
And that is exactly what we are focusing on for this deep dive today. The cryptocurrency XRP, specifically assessing its reality right now in March 2026.
It's a pivotal moment.
It really is. We have a massive stack of analysis covering the desk today. I'm looking at fresh market data, crypto forecasts, these huge regulatory filings, and in-depth reports from Motley Fool, Binance, NASDAQ, and Standard Chartered.
It's a heavy stack.
Yeah.
And when you synthesize it all, it highlights a profound narrative shift that, honestly, most casual observers are completely missing.
Which brings us to the mission of this deep dive. We want to cut through that endless, noisy crypto hype and uncover what is actually happening with XRP on a structural level.
Right.
Why are Wall Street institutions pouring billions into permanent plumbing around an asset that the internet just loves to argue about?
It's the ultimate disconnect.
So whether you are a crypto veteran who has been holding for years, or you're just insanely curious about the mechanical future of global finance, this deep dive is going to serve as your ultimate shortcut to understanding how modern digital assets actually integrate into the real world.
Okay, let's unpack this. Starting with what honestly feels like a hostile Wall Street takeover.
That is precisely the phrase I would use. The starting gun for this whole institutional shift was the launch of the spot XRP exchange-traded funds, or ETFs, back in November 2025.
Right.
You had major players like Canary Capital, Bitwise, 21 Shares, and Grayscale all suddenly entering the arena with SEC-approved products.
And the numbers in this NASDAQ report are just wild.
Yeah.
In under 60 days, these spot XRP ETFs saw over $1.37 billion in inflows.
Incredible volume.
At one point, they hit 43 consecutive days of net positive inflows. Think about that. For a month and a half, Wall Street did not have a single net outflow day. They just kept buying.
Never taking a break. It made XRP the second fastest crypto ETF to cross the $1 billion mark, trailing only behind Bitcoin itself. But this isn't just about lines on a chart going up, is it? There's a physical mechanic happening here.
What's fascinating here is the structural supply squeeze this creates. When an ETF takes in $1 billion, it doesn't just create a paper IOU.
Right, they can't just print it.
Exactly. It is forced to go out and acquire the underlying asset to back those shares. According to the market analysis we have, for every $1 billion that flows into these XRP ETFs, approximately 500 million XRP is physically removed from circulation.
Let me stop you there, because that is the crucial mechanism. It's essentially a giant vacuum cleaner.
Yes.
The ETF providers have to go to over-the-counter desks or public exchanges, buy those 500 million tokens, and lock them in a vault. They are sucked right off the open market.
And when you start looking at the longer-term projections, that vacuum cleaner turns into a black hole. JP Morgan recently issued a prediction that eventually between $3 billion and $8 billion could flow into these XRP ETFs. Furthermore, Jeffrey Kendrick over at Standard Chartered ran the math on a more aggressive scenario. He modeled that if ETF inflows hit $10 billion, it would force the purchase of 4 to 5 billion tokens.
Which is a massive chunk of the available supply.
Huge. Under that specific liquidity crunch, he predicts XRP could hit $8 by the end of 2026, simply because the available supply would be so constrained.
So the scarcity alone acts as a massive price driver. But it begs the question, Wall Street is notoriously risk-averse. Compliance departments run the show over there. Why are they suddenly so eager to vacuum up an asset that just a few years ago was basically considered radioactive by U.S. regulators.
We have to look at the legal cloud that hung over Ripple for 5 long years.
The SEC lawsuit.
SEC lawsuit. It was the defining headwind for XRP, acting as a massive anchor on its price and its adoption in the United States.
It's wild looking back at that filing now. The SEC originally postured for a massive $2 billion penalty. But in August 2025, that dark cloud finally broke. Ripple and the SEC reached a settlement.
And the numbers were very different from that initial $2 billion.
Very different. Looking at the final settlement filings, Ripple walked away paying a massive haircut. Various reports pinned the final number somewhere between $50 million and $125 million, depending on the specific legal categorizations. But either way, it was a tiny fraction of the initial threat.
Right.
More importantly, it brought the one thing Wall Street craves, which is legal clarity. The courts established that XRP, when sold on public exchanges, is not a security.
The ripple effect of that clarity, no pun intended, cannot be overstated. Once that regulatory friction was removed, traditional finance finally felt safe to engage. The compliance departments gave the green light.
Yep.
And we saw this culminate in a massive way in December 2025, when the U.S. Office of the Comptroller of the Currency, the OCC, granted Ripple conditional approval for a National Trust Bank charter. They are establishing the Ripple National Trust Bank, or RNTB.
Let's pause and translate that because National Trust Bank Charter sounds like dry regulatory jargon.
It does.
But a crypto tech company essentially just got a license to operate as a foundational U.S. bank. That bridges the traditional finance world and the crypto world in a way we haven't really seen before.
It creates a fully compliant crypto-native bank. To understand the implications, you have to look at how money actually moves. Currently, crypto companies have to rely on third-party banking partners to interact with the traditional financial system.
Right. They always need a middleman.
Exactly. With this charter, Ripple bypasses the middlemen. Our sources suggest this could potentially allow Ripple to have direct FedWire or FedNow settlements by Q2 or Q3 of 2026.
FedWire is essentially the central nervous system of United States money. If Ripple connects directly to that, they aren't just building software for banks anymore. They are embedding themselves directly into the bedrock of the U.S. banking system.
That's the paradigm shift.
Though, as we look at the legislative reports on the desk, it's not entirely smooth sailing in Washington just yet. There's the Digital Asset Market Clarity Act of 2025. It passed the House with bipartisan support, but it's currently stalled in the Senate after the American Bankers Association rejected a White House compromise.
The legislative environment in Washington remains a significant hurdle. And just a quick sidebar for you listening, we are strictly looking at the legislative data here.
Right, exactly.
We don't have a horse in the political race between the White House, the Senate, or the banking associations. The objective takeaway from the reporting is simply that this legislative logjam is acting as a massive speed bump for the whole crypto market's momentum.
Absolutely, keeping it strictly to the facts on the ground. The laws are lagging behind the technology. But despite those legislative delays in Washington, Ripple itself is operating at breakneck speed. There's a great quote from one of the market analysts in this stack. They said, "Plumbing always comes before price."
I love that quote.
It's perfect. Here's where it gets really interesting. Ripple spent nearly $2.5 billion on blockchain acquisitions last year alone. The crown jewel of that spree was a massive $1.25 billion acquisition of a global institutional prime brokerage called Hidden Road, which they've now rebranded to Ripple Prime.
That acquisition is the literal definition of building the plumbing. You mentioned Wall Street's plumbing earlier. On March 2, 2026, Ripple Prime officially joined the DTCC's NSCC directory.
Which is huge.
Now, for the everyday investor, the DPCC might sound like just another acronym, the Depository Trust and Clearing Corporation. But it is the beating heart of the global financial system. They process quadrillions with a Q in securities transactions annually.
Quadrillions. So to put that in perspective, getting Ripple Prime onto that DTCC directory means XRP is no longer an outsider knocking on the door. It's like plugging a state-of-the-art fiber optic cable directly into an old, dusty switchboard. They have essentially been given a key to the master control room of global finance.
That is the perfect analogy. And to ensure that traditional risk-averse institutional money can actually flow through those new fiber optic pipes securely, Ripple launched their own stablecoin, RLUSD.
Right.
It hit a $1.33 billion market cap within a single year. It is fully backed by U.S. Treasuries and dollar deposits, acting as a compliant, volatility-free bridge for these institutions to move on to the ledger.
Which feeds directly into their on-demand liquidity service, or ODL. The data in this Binance report shows ODL processed over $15 billion in cross-border payments in 2024 alone, spanning across 90-plus payout markets.
Real utility.
Exactly. We aren't talking about people trading meme coins here. We are talking about actual corporate payrolls and cross-border remittances moving through the XRP ledger. But reading further into the data, there is a glaring warning sign flashing red.
Yes, there is. And we have to address it to maintain a balanced view. While the infrastructure growth is undeniable, technical analysts monitor something called the Network Value to Transactions Ratio, or NVT.
Let's break that down for the listener. What exactly is an NVT ratio?
Think of it like a price-to-earnings ratio for a blockchain. It divides the total market cap of the network by its daily transaction volume.
Okay.
If a network is valued at $1 billion, but only processes $10 of actual economic activity a day, the NVT ratio is sky high. It essentially measures whether the valuation is based on actual utility or just speculation. Historically, when the NVT goes over 1,000, it signals that the market value is dangerously exceeding the actual transactional utility.
It's like a wildly hyped nightclub that charges a fortune for a VIP table, but when you look inside, the dance floor is completely empty.
Exactly that. In November 2024, XRP's NVT ratio spiked to 11,162. That is a clear, data-driven warning that the speculative premium might be running far ahead of the actual utility on the network. People were buying the token based on the news of the plumbing long before the water was actually flowing through it.
That makes perfect sense. The hype outpaced the mechanics. But speaking of the water flowing, let's tackle the absolute wildest prediction in this entire stack of sources, the ultimate wildcard.
Yeah.
Several institutional analysts have modeled a potential price target of $245 to $315 per XRP token. Now, I have to be honest, if XRP is currently struggling to hold $1.50, a $300 plus target sounds like absolute meme math. Walk me through how these analysts are possibly justifying that valuation without getting laughed out of the room.
If we connect this to the bigger picture, the math actually becomes mechanical rather than purely speculative. It is entirely based on the tokenization of real-world assets, or RWAs.
Okay.
RWAs, we are talking about taking traditional assets, real estate, stocks, government bonds, and representing them as digital tokens on a blockchain. The global market for these tokenized equities and bonds is projected to hit $200 trillion over the next decade. We already have major traditional players like BlackRock and Aviva Investors actively building in this space.
Right, BlackRock's tokenized fund for U.S. government debt is already a massive success, and the infrastructure allows it to be managed on the XRP blockchain. But how does that translate to a 315 XRP token?
Let's follow the math directly from the institutional models. If the XRP ledger captures just a 1.75% share of that projected $200 trillion market, that equates to $3.5 trillion of actual wealth being settled on chain.
That's a massive number.
It is. Now, to process that kind of volume securely and instantly, the network requires massive internal liquidity. You can't move $1 billion across a bridge if the bridge can only hold $1 million of weight.
Okay, I'm tracking with you. The network needs its own internal value to be high enough to facilitate the transfer of those tokenized assets.
Precisely. If you apply a standard 10% to 15% liquidity requirement to that $3.5 trillion moving across the ledger, it mechanically demands hundreds of billions of dollars in standing XRP liquidity. Because the supply of XRP tokens is mathematically capped and cannot be inflated, the only way the network can absorb that much value is if the per token price mathematically pushes into the hundreds of dollars.
That is a total paradigm shift. It's an aha moment. It's not about retail investors wanting to buy the token to buy a Lamborghini. It's about the financial network literally needing the token to be priced that high just to physically process the sheer volume of global wealth moving across the ledger.
That is the core of the institutional thesis. But it is crucial to emphasize to the listener that this is a multi-year, possibly decade-long thesis. This relies on the full tokenization cycle of global finance maturing. It is absolutely not a guarantee, and it is certainly not a price target for 2026.
I'm glad you clarified that because I want to play devil's advocate right now.
Go for it.
We've talked about all these massive paradigm-shifting developments, billions in ETF inflows, national bank charters, DTCC master keys, and trillions in potential tokenization volume. Yet looking at the daily charts, XRP is down roughly 35% in the last 90 days.
It's true.
It hit a post-election high of $3.66 and has dragged all the way back down to this $1.35 to $1.85 range. Retail investors are bleeding. So what does this all mean in the immediate term?
It means we need a harsh technical reality check. Despite all the fundamental behind-the-scenes progress, the current charts are painting a very bearish picture. Technical analysts point out that XRP has recently formed a death cross pattern.
A death cross always sounds incredibly dramatic. What does that actually mean on a chart?
It's a classic momentum indicator. It occurs when a short-term moving average, specifically the 50-day exponential moving average, crosses below a long-term moving average, like the 200-day EMA.
Okay.
It mathematically signals that the asset's recent momentum is significantly weaker than its long-term trend. It's a sign of extended downside pressure.
So if the momentum is failing, where does the floor drop to if things get truly ugly in the short term?
The immediate bear target, outlined in the technical analysis, is a potential drop to $1.25, which lines up with the flash crash low we saw back in October 2025. That is a major psychological support level.
Right.
But if that critical floor caves in, analysts use Fibonacci extension models to find the next level of support.
Unpack Fibonacci extensions for us, because that sounds like Wall Street voodoo to a lot of people.
It's essentially a mathematical map of human panic. When an asset drops below all its known historical support levels and goes into free fall, traders use these mathematical ratios to predict where buyers might finally step back in. And right now, that map shows a potential trapdoor all the way down to 53 cents if the current macroeconomic floor caves in.
Ouch. A drop to 53 cents would be an absolute bloodbath for anyone who bought near the $3.84 high.
It would be brutal. And we cannot ignore the broader macro environment. XRP does not exist in a vacuum. It maintains a strong 0.85 correlation with Bitcoin.
Meaning?
Basically, if Bitcoin sneezes, XRP catches a cold. The analysis makes it very clear if Bitcoin cannot maintain its price above the $100,000 psychological level and the broader macroeconomic environment turns risk off, perhaps due to renewed inflation fears or interest rate shocks, then no amount of XRP-specific catalysts will save it.
It just gets dragged down.
Exactly. No bank charters, no DTCC integration, and no ETF inflows will prevent it from being dragged down by a broader crypto bear market.
The rising tide lifts all boats, but the draining pool lowers them all too. So to synthesize everything we've dug through in this stack of sources today, the entire narrative around XRP has completely shifted from what it was 5 years ago.
Completely.
It has gone from a speculative, legally embattled token that retail investors day traded based on Twitter hype to a foundational piece of institutional financial plumbing. We are looking at billion-dollar ETF supply shocks, deep integration with Wall Street's oldest clearinghouses, and actual national bank charters being issued.
This raises an important question for you, the listener. Why does this matter to your everyday life? Even if you never download a crypto wallet or never buy a single fraction of a digital asset, watching XRP's integration right now is essentially watching the real-time rewiring of the global financial system. The invisible architecture of how your money moves globally is being fundamentally upgraded before our eyes.
It really is an infrastructural revolution happening in plain sight. And I want to leave you with a final provocative thought to mull over, building directly on the data we've discussed today.
Let's hear it.
Right now, as we speak, there is an estimated $27 trillion trapped in the legacy correspondent banking system. The global economy pays a staggering $1.22 trillion liquidity tax every single year just to move that money around across borders, dealing with 3-day delays, correspondent banking fees, and archaic middlemen. If the traditional financial giants we've discussed today are quietly building the pipes to settle trillions of dollars on a decentralized ledger, a ledger that settles transactions in 3 seconds for fractions of a penny, what happens to that old system? Are we currently witnessing the slow, quiet obsolescence of the phrase traditional banking hours?
When you look at the sheer scale of the capital involved, it is a fascinating prospect to consider. The old system simply cannot compete with the math of the new plumbing.
It changes everything about how the world does business. Thank you for joining us on this deep dive into the true state of XRP and the rewiring of global finance. We encourage you to keep exploring these concepts, keep questioning the hype, and keep learning. Until next time.